What do you think about those valuations and the fact that the U.S. valuations are still so much higher than European and Japanese?
For now, it's probably okay because, as I said, the earnings picture still looks relatively robust. The hurdles weren't really lowered, and the beats that we've seen are clearing those hurdles. And so it's a decent story. The worry is, I think, probably more for the second half of this year into next year, where this recovery continues to age. The fiscal stimulus you might have seen and maybe the boosts to capex that you might get more in the near term as a consequence of corporate tax reform and stimulus, those effects might start to fade. That maybe makes it a bit more worrisome down the road. But for the time being, the picture still, I think, looks pretty rosy.
How do I trade it? I'm not asking you to talk about individual stocks, but J&J yesterday beat expectations, and the market sold it. And I kind of wonder what kind of a clue I can take away from that reaction. There are some idiosyncratic factors around any individual stock, but nevertheless, it's a theme that's already beginning to develop. We're only a week into this thing.
On an index basis, I'm not terribly worried about it in that, after all the volatility we've seen this year, and that's a factor I'll come back to that I think is very important.
We'll talk about vol in the next, because Treasury volatility is coming down pretty sharply.
Yeah.
Anyway, let's come back to that.
But that, I think, has to explain some of it. People are a little bit more heightened to sensitivities in equities than they were in the past couple of years, simply because of the volatility regime we seem to have entered. But let's not forget, the S&P is still up on the year, and so... But after the February and early March that we had, that's fairly impressive in my mind, in that we had such a kind of blow-off type of behavior in January. To pull back somewhat doesn't really overly concern me yet. It's when the cycle gets a little bit more into the late stages, which I think we might be getting to towards the second half of this year and into next year, then I think we have bigger problems.
Tim, can I just ask you about Donald Trump's effect on this volatility? I mean, last year it seemed like the market wasn't concerned when the U.S. president would do things that were out of the ordinary. This year it seems that every headline kind of hits the tape. Does that concern you investing right now when you see the U.S. president getting lined up for, having a meeting with Shinzo Abe, getting lined up for one with possibly Kim Jong-un and even possibly Vladimir Putin?
It's really hard to know because I think the volatility events this year have been caused in February by the Fed. It wasn't so much about Trump then. I don't think the back and forth of his tweets necessarily helps matters, but we've now had more than a year to deal with that type of behavior. And actually last year, volatility remained pretty well suppressed over the course of the year. This year, in fact, you're seeing, to my mind, some balance to some of the statements coming out. So he can be very protectionist on trade, but then make positive soundings about NAFTA from the administration or TPP, even though now that's been walked back. There's just a lot of back and forth. And so I think markets, quite rightly, to use the cliche that has now made the rounds, are paying attention to what Trump does as opposed to what Trump says, because what he says seems to change from day to day, and you can't really trade around that, I don't think.